Good morning, I'm back, and let me give you the reminders and the concept behind our topic, business combination and consolidated FS. Starting with acquisition of net assets or merger. We know that goodwill is the usual result in any business combination, and we engage in acquiring the net assets of another company because of synergy. And only in unusual circumstances that gain on bargain purchase or gain on acquisition results. Okay, so in computing for the goodwill or gain on acquisition, we compare the cost of investment with the identifiable net assets at fair value of the acquired company. Of course, cost of investment will come from the acquirer, who is the surviving company. This may include the consideration transferred or the price paid, which may be in form of cash, shares, just make sure at fair value, bonds at quoted price, and non-cash at fair value. There could also be consideration to be transferred or contingent consideration, and we recognize it on the date of acquisition to the extent it is measurable, determinable, or probable. Then on the other side, we compute for the identifiable assets at fair value less the liabilities of the acquired company at fair value, excluding the previous goodwill of the acquired company or the dissolved company in a merger. If the cost of investment is greater than the identifiable net assets of the acquired company, then the result is a goodwill. Otherwise, if the net assets identifiable at fair value is greater than the cost of investment, then the result is a gain on a bargain purchase. So, also, part of the reminders, the treatment of the cost that we encounter in business combination. Number one, we have the direct costs, accountant's fee, legal fees, finder's fee, pre-acquisition fee. So basically fee, because we only hired them to consummate the merger. They are not employed. They are not employees of the acquirer. So they are treated as expenses incurred. Same is true with indirect costs, accountants, salary of accountants, general and administrative expenses, cost of maintaining a department, so also expenses incurred. When it comes to bond issue costs, if like in our handout, the bonds is treated as a financial liability at an amortized cost, therefore the bond issue cost is a deduction from the premium or addition to the discount. So, stock issuance costs are costs to issue and to register stocks are a deduction from equity. Number one, from the share premium resulting from the issuance of shares. If it is already exhausted, then the share premium from other sources. Then, if exhausted, finally retained earnings. In acquisition of net assets or merger, the common questions are, number one, compute the total assets immediately after the merger. And the computation is, we add, number one, the assets of the acquirer or the assets of the surviving company at book value. Take note, at book value. Then the assets of the acquired company, which the acquirer took over. So, at fair value. Then, of course, the resulting goodwill, if any. Then we deduct all the payments in form of an asset na normally cash. In computing for the total liabilities immediately after the merger, we add the liabilities of the acquirer at book value, again at book value, and the liabilities assumed by the acquirer from the acquired company at fair value, plus the bonds issued at the quoted price, less any bond issue costs, which is a deduction from premium or an addition if in case discount. Then also we add any contingent consideration, which is consideration in form of cash to be transferred on a future date. Of course, to the extent it is probable and measurable. And if in case, although I think it's very remote, any expenses incurred but not yet paid. Then another question is the total stockholders' equity immediately after the merger, starting with the total ordinary shares. The ordinary shares of the acquirer, since the ordinary shares of the dissolved company will be eliminated in its books, plus any shares issued at par. Then the share premium immediately after the merger, the share premium of the acquirer or the surviving company, add the resulting share premium because of due to the issuance of shares if the fair value is more than the par value, then less any stock issuance costs, only to the extent, of course, number one, of the share premium resulting from the business combination. Then if exhausted, the share premium from other sources. Otherwise, then we come to the third, the total RE immediately after the merger, the retained earnings of the surviving company or the acquirer. Then add any gain on acquisition or income from gain from bargain purchase if the result of the business combination is the unusual result, which is again the income from acquisition. It is income immediately, but since on the date of acquisition the only FS available is the statement of financial position, then any items affecting income or expenses will affect retained earnings for the sake of the questions on the date of acquisition, one of which is the income from acquisition, again added to RE. Then deduct the expenses incurred, like the accountant's fee, finder's fee, legal fees, salary of accountants, general and admin expense. Deduct also stock issuance costs if in case the share premium resulting from issuance of shares and other sources are full exhausted. Then I guess that's it for merger. Then also I would like to remind something about the contingent consideration. Again, contingent consideration is part of the total consideration. Of course, to the extent it is probable, identifiable, measurable. So therefore it is added with the consideration transferred to the consideration transferred plus the consideration to be transferred, or contingent consideration, is the total consideration, which will be used in computing for any goodwill or gain resulting from the business combination on the date of acquisition. Then if in case the contingent consideration within the measurement period will change its estimate, again measurement period is within 1 year or 12 months from the date of acquisition, then it may affect the goodwill or the gain on acquisition if, number one, if it is within the measurement period, again within 1 year or 12 months from the date of acquisition, and it is due to an improved, based on an improved estimates from facts and circumstances already existing or known on the date of acquisition. Otherwise, if it is something sort of a surprise, the change in estimate is because of something that happened, like because of something that which is unexpected, like for example typhoon or earthquake or anything that was not known on the date of acquisition, then even if the change in estimate is within 1 year, if it is again not based on improved facts and circumstances, or improved estimates based on facts and circumstances already existing on the date of acquisition, then it will affect income, not anymore goodwill or gain on acquisition. So take note of that. I hope it is clear. So that would be all for merger. Thank you.